Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. I've got some big news. Macro Hive is now 2 years old. Yes, we've just completed our second full year. To mark this, we've dropped our paywall for a week so everyone can come to the Macro Hive website and see our content without logging in. Now, I also thought I'd share 5 numbers that give you a flavor of what's happened at Macro Hive over the past 12 months. The first number is 1,075,337. That's the number of page views to the Macro Hive website over the past year. And a big thanks to all the visitors, especially to the ones from Benin, Eritrea, and Vanuatu. Hopefully I pronounced the latter correctly. You've helped improve my geography. The second number is 402. That's the number of articles we published across our products, Prime and Professional, over the past year. And thanks for the very kind words we get from our readers, like outstanding quantitative macro analysis and the epitome of having your ear to the ground for anything macro related in the world of finance. Now, the third number, 155,246. That's the number of podcast downloads over the past year. The podcast interviews are one of the most fun parts of my job, so this number is gratifying. The fourth number is 10,022. That's the number of workers at Macro Hive. Admittedly, 10,000 of them are bees. Yes, I got a beehive during lockdown. But we do have 22 fantastic people working for Macro Hive across the world, from San Diego in California to Berlin in Germany. Finally, 508. That's the number of members on our Hive Mind Slack chat room. We set up a Slack room for our members during lockdown, and it's steadily grown into a vibrant investor community. We exchange ideas, share insights, and get support when markets go against us. And as you can tell, it's a much healthier environment than Twitter. Hopefully, these numbers give you a flavor of our achievements over the past year, all with the intention of delivering a better service to our members. And if you're not a member, make sure to sign up at macrohive.com. The first month is free, and then it's only the cost of a few weekly cappuccinos. I'd also like to thank the sponsor of this episode, Moonfair. Moonfair believes exceptional investors deserve exceptional returns. Returns like those offered by carefully selected top-tier private equity funds, an asset class that has been for decades out of reach of most investors. Given the current volatility in stock markets, the specter of inflation, low yields on most classic fixed income products, and the advent of all manner of unproven asset classes, Moonfair believes private equity has a place in every portfolio. Fidelity International recently selected Moonfair as its exclusive distribution partner for private equity funds, a confirmation of Moonfair's obsession with picking the best fund managers and all types of private market funds, from venture to growth to buyout and infrastructure funds. Nearly 1,500 investors have trusted Moonfair so far with their money, and the company is hurtling towards 1 billion euros in assets under management. It recently launched a new and improved secondary market in partnership with Lexington, one of the largest private equity secondary fund managers in the world, giving investors the flexibility to exit their positions before a fund's holding period elapses. To get started, please visit moonfair.com/macrohive. That's moonfair.com/macrohive to create your free profile. It's completely free and without any obligation, and gives you access to Moonfair's platform where you can see which funds are available, check out due diligence documentation, and connect with Moonfair's investor solutions team. You can also check out Moonfair's library of white papers exploring different topics around private markets investing, along with some of Moonfair's favorite episodes of the podcast. I've rummaged around the site and it's definitely worth it. So I'd urge you to check out their site, moonfair.com/macrohive. Now, on to this episode's guest, Josef Ackermann. Joe is the former chairman of the management board and group executive committee at Deutsche Bank. Under his leadership in the 2000s, Deutsche Bank became one of the top investment banks in the world. He also managed Deutsche Bank through the global financial crisis. After he stepped down from Deutsche Bank, Joe went on to become the chairman of the board of directors of the Bank of Cyprus until 2019. Joe studied economics and social sciences at the University of St. Gallen, where he earned his doctorate. Now, onto our conversation. Welcome, Joe. It's great to have you on the podcast show. We haven't spoken in a long, long time, so it's good to have you on.
Thank you. I feel honored to be on your podcast, I have to say. Looking forward to your questions.
Great. One thing I always ask my guests is something about their background. I always like to learn about people's origin stories. So, I know you studied, economics at university and you did a doctorate as well. So economics sounds like was always a bit of a passion for you. And also, was it kind of inevitable that you were going to then go into finance after your academics?
No, actually, my father was a medical doctor, so it would have been actually close to become a medical doctor as well. But I was a bit more interested in politics. Although in grammar school, I studied Greek and Latin, and then I got a bit frustrated when I turned 18 or 19 that I couldn't actually understand articles in the newspapers. I didn't understand the technical terms, nor actually the content of whatever has to do with economics. So I felt I should actually start studying economics. And I was fascinated by economics, although my professor of math at the grammar school was a bit disappointed because I liked math and he felt that's a little bit too easy. He didn't know anything about how mathematical, economics become later on. But I loved that a lot. Then, of course, it was a bit the question whether after the thesis, whether I would stay at the university or go into finance or banking. And I felt that I should understand a little bit better how the theory really works in practice. So I started working in a bank and actually never really went back to the university, although I was always part-time lecturing for many, many years. But it was absolutely clear to me that banking is actually the place to be and what I liked very much. So,
and then you started off at Credit Suisse, I suppose in the late 70s. What was kind of the financial world like, in the 70s and early 80s, kind of when you first started?
Well, we were a little bit split into First Boston, which is the investment banking arm, and more the commercial banking, wealth management, which was at that time the Credit Suisse Bank. I started in the Credit Suisse Bank, but then also spent some time at First Boston. And it wasn't, of course, more traditional, but I think we tried to combine investment banking skills with commercial banking skills a little bit the same way as we did later on. What was certainly different that we didn't know derivatives at the time. So about, when was it, in the early 90s, we were approached by actually people from Bankers Trust, whether we would be willing to invest into some sort of a joint venture with them for derivatives. And no one really wanted to do that because people were afraid of, it's too risky and maybe something which will be a nightmare for the one who runs it. And I was pretty young and interested and curious. So I took that job, and that was really the breakthrough within Credit Suisse. And we were quite successful for many years. And then, of course, the First Boston and Credit Suisse got closer and closer.
Yeah. And then you moved over to Deutsche Bank. I think it was in mid-1990s. You sort of moved over to sort of Deutsche Bank, and you eventually went on to become the CEO and chairman for a long period there. And you kind of oversaw, the dramatic growth of Deutsche Bank into kind of a global powerhouse. So there's always been this thing, about can a non-US bank ever take on the big US banks in fixed income or equities? And you really helped propel Deutsche to that level. So what was kind of the idea of trying to make Deutsche more of a global, institution rather than just a German, focused institution?
It's actually a very interesting point. When I worked at Credit Suisse, I was covering multinational companies globally for a while. And a lot of big German companies told me the same all the time, Yes, we have Deutsche Bank and Commerzbank and Dresdner Bank. They're very good for payments and for our lending, borrowing operations. But we are happy to have American and Swiss banks for M&A, for capital markets, and so on. And when I joined Deutsche Bank, for me, it was absolutely clear that this is the area where we have to expand and we have to become better because German big companies were actually eager to have us on board there. And so we went into investment banking and we recruited many, many people from different places, which was quite difficult and challenging, the different cultures. And I must also say, for me, it was very difficult because we were culturally not ready then. We were technically not ready then. And we were, from an accounting perspective, not really ready then. So sometimes I had, I don't know how many faxes or emails every morning from people saying, we can no longer stand that. And and we are moving on to other places. And finally, we had a team and we really worked together. And then I think Bankers Trust acquisition was a bit of a breakthrough, because I remember we had a senior management conference outside of Rome, and a lot of people said, if you don't do anything in the United States, we are not here to stay. And Bankers Trust, although it was a different culture and not easy to integrate, but gave us immediately a platform in the United States, which was so important. And I remember when we went to campuses to present our case, before we had maybe 20 students and probably not the best ones. And then suddenly we had hundreds of students who were interested in our story and were willing to join us. So that was really the breakthrough. And then, I think we came into a very strong position. I always felt that Germany needs a global bank which can operate, together with global German companies or European companies on a global scale. And for me, it was also clear that in order to achieve that, we needed a profit of roughly 4 billion euros at the time. I mean, today, probably the number would be higher. But we achieved that within a very short period of time. Actually, we went up to over 6 billion, and we came through the financial crisis without taxpayer support and all of that. So we could operate out of strengths, and we were clearly one of the, it's arguable, but I would say one of the top 3-4 investment banking franchises in the world.
I mean, there's kind of lots of interesting kind of elements of what you've sort of mentioned. I mean, one thing, obviously, the global financial crisis. I mean, obviously, time has elapsed now, so you can kind of reflect back at it in a different way. But, many people, I was around at the time as well, and it really did feel like the whole banking system was going to collapse. It really felt at the time. Now, with time having elapsed since then, I mean, what's your perspective of, how extreme that moment was?
Well, in addition, I was chairman of the Institute of International Finance, which is this association of the big banks and insurance companies. And I was, very much involved in solving the crisis at the time. And we talked to a lot of politicians around the globe. And I always said the same, this is a systemic risk. And even being a market economist, I think we need a systemic response. And the systemic response means that we need public or taxpayer support or government support. That took a long time, actually. I remember having discussed that with Hank Pauls in the US or many others, Christine Lagarde in France, and of course the heads of the central banks. And there was not the absolute willingness at the time to do that. People underestimated. I remember that the Sandy Weil from Citigroup criticized me in the German press and saying, well, he's still young and he thinks, this is the worst crisis ever. But I have gone through bitter days and he apologized later on because he was dead wrong. No, this was an unbelievable nightmare, and we were really close to a collapse. We had several banks in Europe, and of course, how many banks in the US disappeared? Wachovia, Lehman, Bear Stearns, and many more. So in that sense, the situation was absolutely critical, and to go through that with some sort of strength was really a tremendous demonstration of probably good risk management, but also luck. We also had positions I would rather like to not to have seen. But somehow early in the crisis, and maybe as an economist, I felt this is not a temporary phenomenon. This is a trend, and it will get worse and worse. And so we got rid of positions. And I remember how much I was criticized by a lot of, especially investment bankers, of saying, you are destroying our bonus at year end because it will all come back, and others are holding on to the positions and are doing much better. And I think those did keep the positions, and those who even bought positions from others, also from us, because they felt this is now a tremendous opportunity. They were, of course, dead wrong. And I think really those who somehow understood that this is a trend which is going on for quite some time and will completely change financial markets, including, of course, later on the regulatory framework and including all the legal risk, which we have, of course, not foreseen at the time.
Yeah. And you also sort of talked about before the global financial crisis, when you were building up Deutsche Bank, you were sort of building there was organic growth, there was acquisitions, you were hiring sort of teams from other banks. I mean, how did you, as a CEO, I mean, how did you go about trying to get everyone to work together and try to create culture, a Deutsche Bank culture?
I think all those who joined us, some of them were also, disappointed in other places, but also those who wanted to build on their own career. And I think that's why we tried to find a slogan for a long time. And we were really having all this tremendous endeavor to outperform and this culture of performance. And people rallied behind that because, year after year, we got better, we were more profitable, we won mandates in many places of the world. And of course, I have to admit that compensation went up too in parallel. So it was this kind of performance culture, I think, which made it. And the fact that I think we were very open in respecting each other, whether you are from Latin America, from the Middle East, from Asia, from wherever you come from. I think we were absolutely open. And sometimes I said a bit jokingly, because I'm from Switzerland, which is considered to be a neutral place, that one of my help to the build-up was as a neutral. So, I was not part of one bloc or another bloc. I was really absolutely open to maintain a culture of meritocracy. So whoever was better got the job. And I think people felt that. And we had almost the same team together for many, many years, which was an important, breakthrough.
Yeah. And you mentioned compensation, and then you also mentioned just after the global financial crisis, some, bankers, across the industry were still concerned about the bonuses. I mean, what's your kind of view on, the bonus culture in banks? There's one argument to say that, bonuses, if they're structured correctly, are the correct incentive, and so people should be rewarded. On the other hand, people argue that, it leads to excessive risk-taking behavior, and it leads to bankers promoting the interests of the bank over customers. So that, it's a very heated, topic, this one. I mean, how do you see this?
Yeah, you can imagine in how many political discussions I was involved about bonuses, and I still am. It's very difficult to explain that to people who are not in the industry. By the way, talked about the European Championship in soccer. I mean, many of these people make much more money, which I'm not jealous of, but no one discusses that. And even if they miss a penalty, that's somehow accepted. If a CEO who runs companies of 100,000 more people makes mistakes, that is very costly. It's costly for the economy, it's costly for the people, it's costly for shareholders, for everyone. And so I think whether you went through the crisis without major losses and no public support, or whether you lost dozens of billions of dollars, I think it's a big difference. And a few million up or down in compensation probably doesn't make a difference. But having said that, I think the structure of compensation was not good at the time. We were too volume driven. In some areas we had guarantees which were not good. Many of them not voluntarily, but people said, I only join you when I got a guarantee for the first 2 years. But all of that was probably not good. I think as we have seen, many of the positions became, of course, loss making after several years, and people had already cashed in. So in that sense, we had to change the structure, and that was a good thing. Politically, probably it was also not bad to have some sort of, I wouldn't call it cap, but some limitations on compensation. The chairman of the IIF, the Institute of International Finance, member of the Swiss government, former member of Swiss government, and the chairman of UBS at the time, called me and said, couldn't we agree on a cap of, let's say, 10 million? And I said, okay, I take that up. So I went to the meeting we had in Washington, and I started by saying, there is a proposal for a cap of 10 million. And I have to say that many of the US bank CEOs left the room and called me, the legal counsel called me the other way and said, stop saying that, because this is antitrust. We are in a competitive environment. And if someone is capable of paying higher bonuses, he is better off and gets better people. So in that sense, it's a little bit more complicated, the whole bonus discussion. But I think that over time, we have found a better structure, and the political debate around it has a little bit slowed down, not everywhere in the world, but certainly in the United States or in Asia and other places. In Europe, it's always a special case of compensation. It's primarily true for banks and to some extent also for CEOs of industrial companies, but less so than for banks. Banks are primarily in the focus, and we have to be self-critical. We messed it all up in 2007, 2008. So you had a good argument of saying, well, you always said that your performance is outstanding, that you deserve that kind of compensation. And now we have to support you, and the whole world is falling apart just because of your incentive schemes and your hunger for higher compensation. So in that sense, we were in a quite difficult position. And as chairman at the time, I spent many hours with a lot of people explaining and also saying that we made mistakes. I remember I had in Washington in the press club a speech shortly after the crisis started. And I also explained self-critically what went wrong in the industry. And I think we learned the lessons. We gave out at the time a booklet of lessons from the crisis, and many banks started to follow these advices.
Yeah. And, if we kind of fast forward to today, how do you see the banking landscape? Because right now you see that US banks generally seem to be doing quite well. European banks aren't doing as well. The perennial undervaluation, if you look at, price to book is still, European banks still are trading at a discount, that never kind of converged. I mean, why do you think that is?
Well, let me give you 2 numbers or 4 numbers, which I always like to quote. I mean, in the first quarter 2011, Deutsche Bank had a net profit of $3 billion, and JP Morgan was at 5.6 billion. So not even twice as much. In the first quarter of this year, Deutsche Bank was at $1 billion, and that was the best quarter after, I think, 7 years. And JP Morgan is at 14.3, so almost 15 times higher. Similar development in the market cap, in the global presence, and capital base, and so on. Now, there are a lot of reasons for that. One is, which people, especially in the United States and in Asia, seem to underestimate. The European banks went from the financial crisis into the debt crisis. And the debt crisis was, for many of us, actually worse than the financial crisis. I mean, the Greek exposures, which we had to write down by, I think, 70 or 72%, the uncertainties about other sovereign risks, and many other things. So that was one. The second was the US economy started to grow faster than Europe for many years, actually, and it continued. Thirdly, and I have to say, the TAR program and how they did it in the United States was excellent. They supported banks with capital, but no one actually talks about that anymore. I was, as you know, very much of the opinion that we should not take capital from the governments or from taxpayers for Deutsche Bank for a simple reason. First of all, we didn't need that. And of course, it was a sign of strength to demonstrate that. But secondly, and maybe even more importantly, people would have said that for decades, that we had to rescue this proud bank, and thanks to our taxpayers' money, they survived. And you have seen how much governments intervened in terms of compensation, in terms of decision making, in terms of supervisory board companies, and so on. We would have suffered for decades reputationally. Now you have a similar case in Switzerland. That's UBS. But I have to say that in Switzerland, although it comes up from time to time, but it's not as strict as it would have been probably in other parts of Europe. People talk about it, but they give a lot of credit to new management, and they are not putting any blame on UBS, of the past. And they don't talk about it anymore. So I think the emotional side and the political side was completely different. And in the US, they just allocated capital, and people, whether they needed it or not, and shortly thereafter they gave it back. But it stabilized the banking system. And the last point, of course, we bailed out so many banks in Europe, but we kept them alive, and they are still competitors in the market. Whereas in the US, there was a tremendous consolidation, which made banks, the strong banks, much more stronger. And also with government's support. I think governments and central banks learned the lesson. In the pandemic, it's different. I mean, the way central banks are supporting banks with long-term funding at very attractive rates, the way governments supported the economy or companies, SMEs and others. Of course, it's also helping them primarily, but indirectly it helps banks dramatically because, instead of having huge bankruptcies and huge risk provisions, people could even release provisions they set aside at the beginning of the pandemic. So I think the reaction has been completely different this time from what we have seen in the financial crisis.
Yeah, I mean, and the other thing I think about when I compare the European banks to the US banks is that the US has obviously a very large domestic capital market, and Europe has a kind of a fragmented, although there's supposed to be a capital markets union, but in reality it's the German capital markets, French capital market, Italian capital market. So there isn't really as strong kind of domestic, although there's a euro area economy, the banking opportunities are really at the national level. I mean, how much of an issue do you think that is? And do you think there's a possibility of ever having a proper banking union, capital market union?
Well, that's exactly, of course, a very important point. I mean, that we need consolidation in Europe has been said for years. It's nothing new, but very little has happened. And, I ask myself very often, why? And there are certainly many arguments. One is, I think that we did not fully realize the banking union because we do not have a deposit insurance scheme on a European level. And, Germany has a completely different, because of the savings banks and cooperative banks, as an extremely luxury deposit scheme for private banks, which actually helped, some of the foreign banks to tap funding in the German market, like Lehman did or so, because there was the protection of the private banks' deposit insurance schemes. It actually costs us a lot of money later, and this is still the case. Secondly, a dramatic nexus of sovereign risk and banking risk. I mean, if you look and this has gotten not better, even worse. The sovereign risk in the balance sheets of many European banks is dramatic now. We can say for the time being, the ECB may buy all these assets, but for how long? And we had different cases. By the way, that's why I was always very much in favor of helping Greece, because I felt if this domino effect moves on to Italy or Spain or Portugal or even France at the end, we would have been all dead in the water. I mean, that's why we had to stop the fire in Greece, even at a cost. Thirdly, there was what you mentioned, capital market union. There's no real level playing field. There's no real single market for retail. Every country has different retail products, retail structures. So to get the economies of scale out of that is quite a challenge and probably almost impossible. Another point is certainly the asset quality and, still some risks, legal risk and other risk on the horizon. Regulatory uncertainty was an issue, which is less so, but still a little bit in the minds of people. And of course, the acquisition currency, with the low valuation which we had. And if you take the market cap of Deutsche Bank although tax is 2.5 times higher now than it used to be 10 years ago, but market cap is still below the level we had 10 years ago. So, the acquisition currency is not there. And last but not least, and this is for me quite an important and probably underestimated point, is the political emotional side. When I was running Deutsche Bank, I was approached by 4 or 5 different banks, and they all wanted to merge with us, but they all wanted to be incorporated outside of Germany. So, it's very difficult for a French bank to move to Germany, or for a German bank to move to Spain or to wherever. As long as we don't overcome this political, emotional issues, I think we see a rather more in-market consolidation, but that's very difficult, especially now in the pandemic situation. To lay off 10,000 people is challenging. But after that, it will be, and the more we go back in Europe from more nationalistic thinking again, the more difficult that will be. And how to overcome that, that's contrary to the United States, where, moving from well, I may be wrong, but from Los Angeles to New York is also a challenge, but it's somehow manageable. Whereas moving with the head office in Europe might be, especially for the big bank, for the, let's say, those who are the jewels of a country in the perception of people, that is not easy. And that's probably a more psychological point, but which played a role in my personal case several times, as I said.
Now, one big topic at the moment in the banking sector and finance in general is the whole rise of fintech. As we all know, the cost structure of banks, is very large, and if revenue opportunities and level of yields are quite low, banks have to focus more on the cost side. So you hear all these stories about fintech coming in, disrupting banks and so on. I mean, what are your thoughts on the fintech side of things? And will that somehow disrupt banks and unbundle banks in some way?
Yeah, it is. About 30 years ago, I was asked by the World Economic Forum to, make a presentation on the future of banking. And that was in 1990 for the first time. And I said, I think in 15 years, banking will not be as different as it is today. And although, we talked about GE Capital as being probably the outperformer in our industry, and we talked about other entities who were clearly challenging banks. But I think I was right. And today, I would say everything will be completely different. And it starts with consolidation, but also that the competitive environment has changed. Fintechs are clearly disruptors, but also other areas which will operate in a different environment. Having said that, I'm not so sure whether fintechs will grow, into a situation where they can really challenge the big banks. Clear on the cost side, absolutely yes, but in terms of product, and there are different areas which are a little bit protective for banks. One is the regulatory environment. People have seen that some of the fintechs were not safe havens, and clearly they will look a bit more into how a bank is regulated and supervised. Secondly, banks are not standing still. Of course, they are also taking stakes in fintechs or acquiring fintechs. They are moving into the same areas. And fintech so far are primarily on the credit supply side, on the payment side, on transaction banking, and to some extent on the asset management side or the private wealth management side. But and of course to give more transparency on over different banking relationships. But overall, banks at the end is a relationship business, and I don't think that can be replaced so easily. And you need a global setup. Look at even in private banking, if you don't have a global research somewhat available, it's very difficult to offer the same quality products as someone who can offer that. And in M&A or capital market, you need capital to support that. You need, even in SPACs now, you need the liquidity and capital to support certain transactions, all of that. And you need the network on a global scale. So yes, it is changing the cost culture, it's changing the supply side, but I don't think it is really going to marginalize banks in any time. The famous saying of banking is necessary, banks are not. I still don't think that's the imminent future of the banking industry.
And then how about, the terms of the structure of banks having like commercial banking operations and investment bank operations and, under the same holding company, should you separate investment banking from commercial banking or not? So obviously during Deutsche, you were kind of pushing on all fronts. Now, since the global financial crisis, there's been this whole kind of ring-fencing type arguments and so on. I mean, do you think that's the right setup, or do you think that's just, a phase we're in and, we could sort of move back to a different environment later?
Well, what you should not do, and what I think we never did, is using the funding base of retail, cheap money, and transferring it into riskier investment banking activities. So you should actually add the risk premium to the funding cost. And I think that's very important. For smaller or mid-sized commercial banks, this is a tremendously difficult topic. On one side, even SMEs or, of course, larger corporations, they need more and more investment banking skills and investment banking products, because you want to tap the capital market, you want to do M&A activities, you want to do hedging, you want to do IPOs, and so on and so on. And just to be in the lending and paying and receiving business and transaction banking, so trade finance is a challenge. I mean, when I was chairman of a smaller bank in Cyprus, in order to help them, to survive for a while, we had this discussion all the time. How far can you go? On one side, yes, you should be capable of offering this kind of services, but certainly not moving into a situation where you have to take your own risk. So sales and trading is almost impossible on that scale. But you should have some advisory capabilities. Otherwise, banks or companies will just move on to the bigger banks. And that is a difficult and probably also shows that the size matters, and smaller commercial banks, in my view, will have a tough time to survive. When I was in the 70s, I attended in New York. I attended a seminar at the time at JP Morgan. And we talked a lot about disintermediation. 80% of funding in the United States was through capital market and money market, and in Europe was almost the other way around. And I was a strong believer that disintermediation will become more and more important. That's, by the way, one of the reasons I felt that going into investment banking is the only future. And in today's world, this is even more so. I mean, now we are more and more talking about, and you mentioned that, the capital market union in Europe. And it is now, we are making some progress, the European Commission, and we have to move on, because the big funding needs can only be satisfied with and met with capital market activities. And that means that you need, those banks who can broker between investors and companies or other borrowers.
Yeah, absolutely. Yeah. And I also kind of wonder whether, the fact that the US has such large capital markets, whether that's helped their, the whole VC environment, the venture capital environment in the US and tech startups and Europe has always lagged behind. And it kind of seems like it's partly at least to do with the fact that, you do need capital markets to, be able to support startups.
Well, it's a very important problem. We complain about that now for decades. And that, why are some of the innovative ideas being developed in Europe, but then moved to the United States in order to be implemented? And that's one of them. There are several reasons, but one of the major reasons, of course, is the capital market. That's why we are all bombarded by people, whether we are willing to allocate some money to them. And this is not really working. A bit better in some countries, but not on a European scale.
Yeah. Now, we've talked, a lot about sort of the banking side. What about the asset management side? I mean, you're in Switzerland, obviously the home of private banking. There's obviously different layers of the asset management community. There's kind of institutional asset managers, private banking, private asset management. There's lots of challenges to that sector. One is being the rise of passive and all these index trackers, has been kind of one big thing that's, really affected the sort of industry. I mean, do you have a kind of a view on, the active versus passive debate? And then more generally, your view on kind of the future of asset management?
Well, let me quickly start with asset management. I think most European players are just too small. And that's why a lot of merger discussions go on in Europe in the asset management field. There's a concrete case right now, as you know, and we are hovering around the similar revenue or profitability base in the last almost 15 to 20 years. It's amazing. I mean, if you take some of the big suppliers of mutual funds, maybe it's 100 million up or down, but it's not a real breakthrough. It's quite amazing. So we need consolidation there. That's absolutely clear to me. But
and the benefit of consolidation would be to do with cost advantages and distribution advantages. I mean, why is the size important?
Well, costs are clearly obvious, but distribution are more important. And people are still, we tried very much out of Germany to sell mutual funds into France, into Switzerland, with some success, but people are actually buying their own funds in their own country. And of course, you need this international distribution network in order to gain market share in that respect. Now, to active and passive, well, I mean, there are many studies, saying that passive are normally outperforming active. And I have here, just based on my own experience, of course, for those who don't have, the knowledge and don't have the time to study markets and companies on a larger scale, for them, I think, is the passive side or discretionary side, where you give a mandate to banks, probably a good way forward. And I use that too, passive asset management, but passive private banking. But I'm also a strong believer that if you have some conviction on certain areas, that the active private banking is quite attractive. And if I look at the last 10 years, I think I always outperformed or mostly outperformed passive products by some, conviction trades where I felt this is now a good time to invest, or where I saw advantages in many years without any insider knowledge, of course. But it requires a lot of work. And, as a retired person, I have a bit more time now to go into some depths into different structured products or companies or regions. But I like, as from a banking perspective, although it's not cheap, is to have this kind of advice service where, a bank calls you and based on their own analysis and helps you to find or to give you some good advice. So the mix of passives, ETFs, especially in certain themes, like batteries or whatever, fintechs, as we mentioned before. And then you have the more active, where you think, okay, these are companies I know, I trust, I know the people there, and you pick them. And this combination for me is the best. So I would argue that, yes, passive in normally is outperforming, but it depends a bit on the investor. And if you have time and hopefully the expertise to do some sort of stock picking, you are probably better off. But as a combination of all of that. Now, of course, on top of that, there comes now new challenges for banks, and robo-advisor is one word which I would like to mention. And of course, digitization is very important. So as a client of a bank, what I like is, of course, to have digital access, but I can have my portfolio on the screen all the time, as accurate as possible, and at the same time have some human touch and some relationship with one or two bankers who are not just the relationship people, but also the analysts or those who are more in the portfolio, on the portfolio side of the bank, and maybe even the trading side. And I think this is adding additional value to a client. But of course, this is not true for retail, or a bit difficult for retail or the mass affluent clients. So, but for let's say those who can invest a little bit more, this is for me the ideal combination. And banks who can offer this kind of service, I think, are extremely well positioned.
Now, one thing we haven't talked about so far is actually China. And, there's always been this thing how China's the next big market for everybody, including banks. And, the question there is, is it really possible for Western financials to meaningfully, have a presence in China or not? Do you think?
Depends on where the presence. As you probably remember, we were in the lead management group of all 4 IPOs of the large Chinese banks at the time. And that was a very attractive transactions, together with Goldman and Morgan Stanley and probably JP Morgan at the time, but I don't remember all the names. But yes, in investment banking and in asset and wealth management, it's absolutely possible. And it will happen more and more so. Look at how American banks are critical of what the new administration and previous administration are doing in terms of this China confrontation, because they all see that China is slowly but surely opening up and inviting foreign financial institutions to participate in their economy. And that is absolutely the case, and it's very attractive going forward. In retail and in pure lending, commercial banking, I think that will be very difficult. I mean, we had at the time 20% stake in one of the mid-sized banks. Was quite attractive as an investment, but of course we had no possibility to play a role in the retail or commercial banking market. And I think that will not change because the Chinese banks are very big, very profitable, very strong, and also politically that will not be the case that they open up. But where they see, innovations, where they see products they can help and where they can benefit from, absolutely, you have a chance to increase market share. And that's why I think, but that's now more a political remark, it's very important that we try to have cooperation with China and not confrontation, because, those who will have confrontation will probably end up losing that market. And that would be not very attractive for banks or insurance companies the same, or asset managers.
I could definitely tell that your Swiss side is coming out again in terms of neutrality.
I understand there is, of course, a big rivalry between those countries who were dominating the world and those who are now becoming serious competitors. What I'm saying is, for Europe, we should not be pulled into one block or the other. We should have our own clear view. And I'm not talking about Switzerland, we are too small for that, but Europe as a whole, because we should have our own strategy and our own position vis-a-vis China, because China, whether we like it or not, will be an very, very important factor in the decades to come, and we should not lose that.
And we've talked a lot about big picture stuff. I wanted now to ask some sort of more personal questions. One is, this is kind of a new question I've started to ask recently to my guests, which is, what's the best investment advice that you've ever received?
Well, I think Warren Buffett said is probably a very good one, and I normally try to stick to that. Only invest in assets which you really understand. And that is, very important. I made a mistake in investing in a fintech because I really didn't understand quite what they wanted to offer. Although I understood the product, but I didn't ask probably sufficiently the question, how are you going to monetize that? And that is a bit more challenging in many cases. So, but really what you understand. The second one, sometimes, people tend to be too greedy and to stay on too long, and the trend will continue. And I learned a bit the lesson that if you had a nice profit, good profit, and you think the trend is coming to an end, better sell, because even if it goes on a little bit more, and I always say, with opportunity costs, you sleep much better than with losses. And I think that's true in many areas of life. Opportunity costs you may regret, but this is something you can accept, but losses are a bit more difficult.
And then another question was just about how you manage, your the research and information flows, because it's so easy to be overwhelmed by information and so on. Do you have a routine in terms of filtering, good information and research from bad, and to know what you should focus on?
Well, whether you like it or not, you're probably forced to read a lot. And of course, today we are having access to all kinds of information left and right, but probably you learn after a while how to differentiate between good research and bad research, and then you stop reading it. Of course, you can also put, which I still do, I print certain things and then I read it in the plane or over the weekend, and that you differentiate, what is important, what is less important. And of course, what is urgent, less urgent. What is a CEO also, of course, something which is something, a cost or a burden you have to accept. That's, of course, the media coverage. And the Prime Minister of Italy, the former Berlusconi, once gave me or passed on an advice he got from Baroness Thatcher, who said, ask your people to show you only the positive articles, and then you have very little to read. And I have to say, I did it the same way. Now, of course, from time to time, you have to read the critical as well as to get to know a bit what's being criticized. But hour after hour, to read all these articles about you or about your company is actually probably not very healthy and not very helpful either, because there's not much you get out of it. So, but from time to time, maybe to read a positive article is quite encouraging.
And then the final question I wanted to ask was, what books have really influenced you over your career, or, it could be work related or it could be personal?
Well, when, it's on a personal level, maybe a bit additional, but I must say a book which I still read from time to time and had probably a big impact on me in many areas. I mean, so the wisdom of the book is probably the Faust from Goethe, which I still find one of the greatest books. And of course, in a work context, unfortunately, this is no longer the case the same way. But whenever I went to New York, I spent hours over the weekend in bookstores, just going through all the management books and banking books and product books and so. And if I had to mention 3 or 4 which probably had an impact, is probably the books about team building, probably certainly In Search of Excellence at the time, probably Built to Last was one, and I read with great interest and quite often Peter Drucker's books on management. And, maybe for an hour or so, I actually liked the book, The 1 Minute Manager, which gave some input into how to manage yourself, how to manage a company or a division. So these are certainly a few books which had an impact.
And that's great. And just on the Faust, I mean, presumably you read it in the original German, I assume.
Yes.
And out of interest, how many languages are you competent in?
Well, of course, in Switzerland, you should speak 3 languages. That's German, French, and Italian. And then, of course, if you travel in the world, you have to know English. And I also studied a little bit Spanish, but I must say I confuse it quite easily with Italian. So I would say I speak 4 languages: English, German, Swiss German and good German, of course, and French and English.
Oh, no, that's great. It's good to know. Well, it was excellent speaking to you. I've really enjoyed our conversation. And so I just wanted to give you a big thank you for taking part in our podcast.
Thank you. And excellent questions, which really made me think hard from time to time. So congratulations.
I'd like to thank Moonfair for sponsoring this episode. Moonfair is now launching its Moonfair Growth Equity Portfolio, a product to make private equity growth and tech funds easier than ever for individual investors to access. The days of buying the post-IPO pop are over. Private equity growth funds are claiming more and more of the value that comes from tech companies of all stripes. Since the early 2000s, the typical time to IPO has increased from 3 years to 10 years or more, according to a Carlyle Group analysis of research conducted by 2 Texas University professors of finance, Keith Brown and Ken Williams. Investors in these private companies, meanwhile, claim 80% of the value created, according to Brown and Wiles. Moonfair's growth equity portfolio allows investors to capture this value. Moonfair's portfolio of growth equity funds is available in some markets from minimums as low as $60,000. To get started, please visit moonfair.com/macrohive and create your free profile. It's completely free and without any obligations. And it will give you access to Moonfair's platform where you can see which funds are available, check out due diligence documentation, and connect with Moonfair's investor solutions team. You can also check out Moonfair's library of white papers exploring different topics around private markets, investing, along with some of Moonfair's favorite episodes of the podcast. So with that, thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating and a nice comment. Let other people know about the show too. We'd be really grateful. Also, sign up to become a member at macrohive.com. We'll be back soon, so tune in then.